Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, with the introduction of online purchase, term plans have seen a lot of favor amongst those buying policies. But traditionally, the Indian consumer has preferred returns on investment, and so the growth has not been as fast as expected. Now, looking at this preference, the insurers have launched some innovative policies like the return of premium or ROP plan. To understand what features and benefits ROPs have, we have with us Yashish Dahiya, CEO and founder of Policy Bazaar. Welcome to the show, Yashish. What are ROPs and how are they different from the simple term plans that we know of?
Sure. So as one knows, a term plan, it is an individual pays a certain premium every year. Let's say you take a term plan for 30 years. Anyone takes a plan for 30 years. For 30 years, they will pay a certain premium. If an unfortunate event happens at any stage during these 30 years, their nominee receives that amount of sum assured. So suppose it's a 1 crore sum assured and the individual is paying 10,000 rupees every year for that. If during the 30 years at any stage an unfortunate event happens, their nominee will receive that 1 crore rupees. However, if they survive this 30-year period with no misfortune and they're fortunate enough to survive it, they will not receive any money back. Now, what a return on premium does, if you look at it, the person has paid 10,000 rupees every year for 30 years. So cumulatively, about 3 lakh rupees has been paid. Now, what a return on premium will do, it will pay back 3 lakh rupees at the end of the period. So what that means is whatever investment the individual has made over the duration of the policy will in a guaranteed way be returned back to the individual on survival.
So, it sounds great, but is there a catch to it? And how does the company actually, how do the premiums work and how does the company actually underwrite this?
See, from an underwriting perspective, it's very simple. It's like a term product with something like a fixed deposit. So essentially what you're doing is you're taking a term product where you were paying the 10,000 rupees per year. And in addition to that, you're starting to invest a little amount more, which will build up over the 30 years towards this 3 lakh rupees coming back, or 3 lakh plus. Suppose you're paying a certain amount. Suppose you're paying 10,000 rupees more, it'll become 6 lakh rupees. That's 6 lakh rupees coming back to you at the end of those 30 years. So it's like an FD plus a term plan rolled into one. The rationale for it is largely because consumers don't want to lose anything. So they feel like if this money is gone and they don't get it back.
So is that a notional feeling? Because
it's a psychological feeling.
It's that psychological comfort that you have that, you're giving some money in and then you'll get something back.
How many of us keep money in our savings accounts, for example, without bothering about what interest rate we're earning on it? Some bank may be advertising 7% and your or my money might be lying in another bank account at 2%. And we don't get very worried and worked up about it. And there'll be a certain amount of money always lying there. So to an extent, it's a notional feeling that people have. Everybody's not extremely precise about their financial investment. So it's more of a notional psychological thing that, hey, I will get my money back. It works quite a bit like endowment plans. If you think of endowment plans, how does an endowment plan work? An individual invests a certain money for, let's say, 20 years, and then they get back pretty much their own money with maybe a 2-4% return. That is precisely how a term return on premium works. It may not give you a 2-4% return. It might give you a 0 or 1% return. But it will cost less than an endowment plan.
So in terms of financials, because at the end of the day, that's what we're looking at,
yes.
Does it really benefit the consumer? So go into the pros of it before we go into the cons of it.
Yeah. If you look at it from a pure financial perspective, the TROPs that exist in the market today do not beat a term insurance plan and a fixed deposit. So however, you don't get fixed deposits for 20 years. You only get fixed deposit for 10 years.
Right.
So over time, if the interest rates come down, there is some confusion. However, TROPs tend to be a little more expensive compared to term products, a lot more expensive compared to term products. So from a financial perspective, I would not advise anybody a TROP product. However, we as humans are such, we don't feel very happy when we gain 100 rupees, but we feel very bad if we lose 100 rupees. So if you look at the psychology of a human being, they're very happy when you gain 100 bucks. But you're very unhappy when you lose 100 rupees. And so that loss is taken care of in the sense that feeling of loss that I'm paying this, getting nothing back. If the fact that you would receive your money back increases the number of people taking term insurance in the first place, I think then it's a fantastic product. Because in an endowment plan, typically the way it works, just to put the maths of an endowment plan versus this, typically the way it works is you would just take about 10 times your premium as your sum assured in an endowment plan.
Right.
So you're investing 1 lakh rupees a month, a year, and you are receiving a 10 lakh rupee sum assured. It's not really giving any significant coverage. In a term plan, at 10,000 rupees, one can get 1 crore cover. So if you kind of compare these, at 10,000 rupees in an endowment plan, you're getting a 1 lakh cover. In a term plan, you're getting a 1 crore cover. So you're getting 100 times more cover in a term plan compared to an...
So, we'll get into that aspect.
Sure.
We'll get into that just a little later. But what about the cons? Can we look at the cons?
The cons are it is more expensive compared to a term plus fixed deposit. But so are the endowment plans. So I think most endowment plans can be beaten by a fixed deposit plus a term combination. The only thing is you don't get fixed deposits that long. If you assume you can get fixed deposits for a long period of time at an 8% kind of return, then no endowment product is going to give you that 8% return. And 8% over a period of time becomes very significant. So 8% over 8 to 9 years doubles your money. Whereas these products are just saying they want to return your base premium back. So of course, from a financial perspective, they're not extremely strong. But from a psychological perspective, if that increases the term market, I think it's a great tool.
So what are the products which are available in the market that some of the consumers can go in and at least look and see the benefits of those?
So there's a product from Aviva, there's a product from MetLife, there's a product from Tata, there's a product from LIC, there's also a product from Reliance, and there are new products coming on from Aegon and from HDFC, which are more related to return of premium. But the products will be pretty much based on the same logic that existing products are based on, and they will cost a few times more than the base term cover. I think the important point that one is trying to make in favor of a TROP is, as I was saying, in an endowment plan, you are getting 10 times your cover of your annual expense. In a term product, you're getting 1,000 times the cover.
Right.
But in a TROP plan, you will get about 200-300 times your cover. So from an endowment to TROP perspective, it's a great product if it helps people buy term products more. So the protection element can really go up. Because why are people choosing endowment products over term products? If you look in the country, you've got 90% of your products sold are endowment products, whereas 1-2% is term. Why is that? The reason is the consumer is not happy to lose that 10,000 rupees also. And because of that, he never takes the term protection.
And is that basically an Indian phenomena?
It's a worldwide phenomena. We don't want to lose money anytime. But nobody wants to lose money. Nobody wants money down the drain. One is happy if they don't get an interest return on it. So as I said, it's the psychology of the positive and the negative. The positive makes you feel far less happy than the negative makes you feel sad. So that it's just irrational from a financial perspective, but from a psychological perspective, that is exactly how the human being operates. If you earned, if you get a 10% increment, one feels happy about it. If one gets a 10% decrement, imagine the unhappiness if somebody gets a 10% reduction in salary.
Right.
So it's the same thing. But what one is saying is that if, from a psychological perspective, TROP helps the consumer buy a lot more term because he's confident he's going to get his money back, then I would totally welcome this product. Because if the reason term is not expanding is only for psychological reasons, then might as well. And let's think about it personally. How many of us are so perfect in our financial planning that we will take a term plan, invest 10,000 rupees per year, and in addition take a fixed deposit and make sure we invest 10,000 rupees every year in that fixed deposit for the next 30 years, and at the end of it have created a 6 lakh rupee. We're not.
So it just makes planning a lot simpler. That's what you're saying, because it becomes more complicated the more products.
It's not a very expensive product.
Right.
It makes you sleep well at night.
Right.
In case there is a misfortune, the family is taken care of. In case there is no misfortune, great. At the end of it, you will get all your money back.
So Yashish, how does a consumer actually evaluate and say, this ROP is correct for me? And also, could you explain in terms of the monies, in terms of, if you take a term insurance plans, that is how much it's going to cost. But if you take a ROP, how much the increment on that would be? Sure.
So let's break it down. Let's talk about somebody taking a 10 lakh rupee life cover, right? If you take a 10 lakh rupee life cover today, if anybody takes a 10 lakh rupee life cover, chances are the term insurance plan is going to cost about 1,000 rupees per year, or about 100 rupees per month. That is what the term plan is going to cost. What a TROP will cost is between 2 to 3 times that. Now, why I say 2 to 3 times? So it'll cost 200 rupees per month or 300 rupees per month. The reason is, depends on tenure. The longer duration you take a plan for, the TROP becomes cheaper and the term becomes expensive. The reason term becomes expensive because the chances of death are far higher at an older age. However, the reason the TROP becomes, the return on premium becomes cheaper, is because over a longer period of time, your compounding of interest works in your favor, so you will get your money back. So you can easily get it about double the cost of a term product. If you're looking at a 20, 30-year product, you will get it at that price and you will receive your monies back. Just for a fraction of a second, I want to compare this to an endowment product. If you wanted to take an endowment cover of 10 lakh rupees, you are going to end up paying roughly about 1 lakh rupees per year compared to 2,000-3,000 rupees. So just to put it in perspective, the endowment is a far, far more expensive product compared to the return on premium. And the returns are not that much greater. Most people will be quite happy to have just got their monies back and maybe 2-3% return. So the TROP is far superior to the endowment products. And the reason I'm promoting TROPs is only because 90% plus of what we actually sell is endowment plans, whereas only 1% is term. So if TROP helps this term go from 1% to 5%, it'll be a phenomenal situation.
Yeah. Yashish, we are talking about ROPs. What about the tax element? Consumers who buy it get full tax benefits, don't they?
That's the advantage of the insurance products today compared to almost any other product in the market, in the financial services. Compared to for a TROP, when you're investing, you get the full tax break on the amount you've invested. More importantly, when you receive the money back again, it is tax-free. And obviously, in case of an unfortunate event, the mortality payments are always tax-free. So there are some elements here. Just think about it. When one invests double of what you're investing in the term plan, one is actually not investing double. One is only investing 70% more because somebody who's doing that may be at a 30% tax bracket. And when one receives the money back is always without taxes, which automatically means it's almost 1.5 times compared to the earning you would have had to make at that time to receive the same amount of money. So tax element does work in favor of TROPs. Another way to think about a TROP is think of it from an interest component. Okay, it's double the cost, but what is the interest you're going to make on double the money? The interest you're going to make is only 10% at most, right? So if you've spent, let's say, 20,000 rupees or 10,000 rupees, the interest component on that in a year will at most be 1,000 rupees. So you're actually getting your term cover for just the interest component. So one can almost think of TROP as getting your term or your life cover instead of the interest you would have received on the money. And then, financially also it starts to make sense.
All right, so it's time to take consumers' questions. We've got Ankit Pal from Madhya Pradesh, and he says, I want to take a critical illness policy for my wife who is 28 years old. Now he asks what the difference is between general critical illness policy and also specifically Bajaj Women's Special Critical Illness Policy. Do I need to take two policies to cover all these?
Okay. So in general, my advice would be to take the generic critical illness policies because the women's specific critical illness policies are essentially a subset, mostly, of the base critical illness policies. So while a base critical policy can cover between 15 to 35 critical illness, actually 10 to 35 critical illnesses, and one should be very careful about looking at which critical illnesses are covered. The women specific critical illness policies will usually cover diseases which are more related to women. So, breast cancer, ovarian cancer, those types of diseases which have, a very specific place which is largely around, they're women centric. But as a general piece of advice, if these diseases are also covered in a generic policy, then it's better to take the generic policy from a spend versus, from a value for money perspective, that will work out better.
Right, we've got Joseph Sen from Kochi, and he says, I'm 28 years old and he has epilepsy. It's towards the end, the treatment is towards its end of 3 years that he's been getting treatment. He says, my bipolar was identified 7 years back, and I'm taking medication without any issues. I recently applied for Aegon Religare, for a sum of 1 crore till 75 years, but after 2 weeks, the policy got rejected. Can you please suggest which other companies that he could apply for?
So there are two elements here. One is which company could you get the cover from, and the second is how much cover you could receive. One would almost suggest applying to many companies and finding out, or speaking to multiple companies and finding out, because there is no specific manner in which you can decide whether a company is going to reject or not reject, because most of these are going to be, humanly underwritten. So in the sense, the policy will go back to the underwriting department, and the underwriting department will make a call looking at the facts of the case, whether they can or cannot underwrite it. It would be a combination of how much they can underwrite, whether they will charge an additional loading on the premium. So similar conversations will happen. I would say, speak to a few. One company that does provide coverages is ICICI Prudential up to 1 crore. They don't have medicals. However, you would need to declare your condition, and then basis your condition, they may or may not provide you cover.
Right, we've got Siddhartha Bhandari from Bangalore. He says, I had an accident and has he had a tibial fracture. Now it has recovered, but he asks that if his knee needs to be replaced sometime in the future, will it be considered as a pre-existing disease? He also says that a lot of the policies do not cover injuries due to an attack and a terrorist attack, he asks, and is that true?
Every policy is different. However, in this particular case, he would need to declare this as a pre-existing condition, and once the pre-existing condition is over, then the knee injury can be addressed. So there's an exclusion period in most policies. As far as armed action is concerned, that's more for paramilitary forces, etc., where if they are in conflict and some incident happens in conflict, some of those pieces are not covered by general medical insurance policies, and that's why those entities like the armed forces, etc., would have their own hospitalization and their own coverages, whereas the private health insurance companies won't be covering those situations. I think those terrorism is not an exclusion in every policy, and if you look, in fact, in most policies, it's not an exclusion. So if you do get injured in a terrorist activity or attack, then yes, that is in most policies it is covered. It is more of in some of the personal accident policies, it is not covered, but you can take out a separate terrorism cover. It's quite cheap. 1 lakh rupees is costing about 17-18 rupees per year. So it's not a very significant cost. One can take out a specific coverage also, which is only for terrorist activities.
Right, we've got Jaspal Virk from Ludhiana. He says, we are traveling to Canada with a family of 3 to 4 in 3 to 4 months, and starting this Friday, they've got their visas, confirmed tickets. He's basically asking about the best travel insurance plans, and he says, though we've got travel insurance when we bought the ticket, do we need additional health insurance during our stay in Canada? 4 members, the parents are in the 40s, the children are below 20.
I think they should take about a $1 lakh, $100,000 travel insurance. A travel insurance is essentially a health insurance plan with a few add-ons like loss of baggage, etc. They've got multiple options. I would certainly suggest if they looked at the AIG product, for example, the Tata AIG product, I think it'll be quite nice. It's not a specific one. You could look at some of the others, but the Tata, because AIG seems to have a good coverage across America, so you could look at that one.
Thanks, Yashish. Now, that's all the time that we have on this show of Policy Bazaar. But you can write your queries at ask.policybazaar.com. You can tweet us at policybazaar_, and we'll see you next time. Goodbye.